I'm Veronica Irwin, and I'm a reporter at Unchained. And I'm here with Austin Campbell, the founder of Zero Knowledge Consulting and a professor at NYU and also Columbia Business School. Austin, it's nice to talk with you today.
Nice to see you, Veronica.
So, I thought you would be a very good person to talk to about what has had crypto X in a tizzy for the last week or so, which is Operation Choke Point 2.0. And now that's a term that was coined by Nick Carter, a crypto investor and venture capital general partner at Castle Island Ventures. But can you explain just what that term means?
Yeah, and to do that, we need to talk about the original Operation Choke Point, which I will note is ironically the name the banking regulators themselves were using for it at the time. So, in the early 2010s, under the Obama administration, there was an effort that facially was said to combat anti-financial crime, like so financial fraud, scams, bad actors, etc., which in and of itself is a totally fine goal. But what they were actually doing under the hood was targeting specific industries they wanted to debank and treating people unequally in order to get rid of them in the financial system. And the targets in the original Operation Choke Point were people like payday lenders, firearms dealers, online gambling, things of that sort. So many of them call it politically disfavored targets, other than maybe the firearm dealers, who obviously had a lot of support on the right at the time. But what was going on as a result was banks who banked these industries were being extremely and disproportionately pressured through a variety of regulatory tools to get rid of these clients. So then we come to Operation Choke Point 2.0 and what is going on here. And what is alleged throughout the industry, and there is at least some amount of supporting evidence for it, is that it is that same playbook, but turned against crypto, where under the guise of, again, financial risk and fighting financial crime and combating frauds, that the regulators are applying massive and disproportionate pressure specifically to banks who bank the crypto industry, as opposed to sort of applying those rules across all industries.
So, what really kicked off a lot of this was a post from Nick Carter where he was taking out sections of a new filing in the Silvergate bankruptcy. And this filing was a declaration from Silvergate's chief administrative officer, Elaine Hetrick. Can you explain to me why this filing was so important or so revelatory to a lot of folks in crypto Twitter, including yourself?
Yeah, so a lot of the problem with things like Choke Point 2.0 or the original Choke Point or many allegations of government action is that there's a lot of hearsay in the market about what's going on. It's he said, she said, I heard from a guy, I know a dude sort of problems. What rarely is there is direct, clear, and obvious communication between a regulator and a bank that was inappropriate. And in this case, the Silvergate filing contained some specific, call it statements on the record. So this is a court filing, right? Like you are not supposed to be lying in those, of regulators applying extreme pressure to Silvergate, specifically with regard to the fact that they were banking the crypto industry. So if you were somebody who was looking for where is the there for something like Choke Point 2.0, I would say the two sets of statements that we have that are the most confirmatory on the record so far are now, in this case, from Silvergate. And if you look at some of the factual record in the Custodia case, some of the filings there where it was clear there was anti-crypto animus around the denial of their FedMaster account.
And part of what people were talking about in response to this filing, and to be clear, the filing itself does not say this, but there's this rumor going around that the Fed and federal regulators as a whole, really, but especially the Fed, were pressuring banks serving the crypto industry to cap their crypto deposits at 15% specifically. You were one of the people to post about that on X. Why is that so controversial? And what is another way that the Fed could regulate banks serving crypto that you think would be more effective?
Yeah, so I'll start by saying we need to understand what the problem really was alleged to be with the banks banking crypto and where they got themselves into trouble to unwind that thread. So if you think of traditional banking activities, to kind of oversimplify how a bank operates, they take money from depositors and then they go and they lend that money. And the loans are not usually immediately recallable on demand by the bank, right? So, for instance, if they've lent you money to buy a house, they can't come to you and be like, yo, somebody wants their money back, so sell your house and repay the loan. That's not how the terms of these agreements work. And the problem that banks have historically run into, and this has been a problem for like hundreds of years, this is nothing new, is that they will have depositors who want their money back and they don't have the money because the loans have either not repaid or have gone bad. And so, in the case of Silvergate, also in the case of like Silicon Valley Bank, which doesn't appear to largely have been caused by crypto, the issue was they had depositors withdrawing, but they had gone long on the loan side of the book. So they're long duration in like banking terms, and they don't have the cash on hand to pay back the depositors. So you end up fire sailing whatever you can, degrading your balance sheet, and that creates a run. So the real misunderstanding here is not banking the crypto industry. That's fine because as a thought experiment, if Silvergate had just banked crypto and bought only T-bills, they would have been completely fine. They could have sold all of them and returned people their money instantaneously. The issue is in what's called the asset liability matching between the deposit side of the balance sheet and what they were doing with the money that they received. That's where you get into this whole idea of the 15% cap. What that's sort of doing is stapling, call it early 1900s thinking, onto the modern banking system, right? It's saying that all banks should have diversified depositor bases that do things like make mortgage loans in their local community and lend money to the local businesses. It's a very sort of, bucolic and almost ahistorical, if you will, view of banking, because there have always been specialist banks for industries instead of saying, hey, let's get to the root of the problem. You guys screwed up your asset liability matching. And I think there's two reasons for it. One is, as you said, if we're talking about an operation choke point style thing, what you want to do is come up with something that facially looks like you're protecting against risk, but functionally debanks people. Right. And this sort of deposit cap is not typically applied to other industries. You don't see people going around and being like, 15% is really high for the insurance industry. So, like, get your deposits down if you bank insurance companies. They're like, those auto manufacturers, I've got questions. Right. So, the fact that it's so targeted and industry specific should raise some concerns in that regard. And then it's also probably a way for the banking regulators to try to distract from the fact that allowing a bank balance sheet to get that unbalanced is a real failure of regulatory supervision, right? They are supposed to be overlooking these banks and making sure that the asset liability matching programs operate effectively. And in the regional banking crisis, we saw that there were multiple banks that were not doing that. And I think it's easier for the regulators to blame an industry than look at themselves and, publicly admit, hey, we screwed up here.
Yeah, can you provide any just examples for people to be able to reference of banks that do successfully like specialize in a specific industry?
Yeah, so historically, you have banks like MVB that have done high risk payments across the industry, right? Like they've served the online gambling industry. There are multiple banks that serve people like, trade finance, shipping, or specific verticals in emerging markets. Some would say, like, a large scale example of this is literally Standard Chartered. And, the thing is, in our head, when we think of a bank, we think primarily of mortgage lending. But the reality is, many modern banks do not operate that way. So, for instance, I spent a lot of time at JP Morgan. And if you go look at JP Morgan's balance sheet, they've got a gigantic investment bank. They have a huge asset management division. They've got a private wealth division. They do have Chase, which is a large retail bank, but like Chase is not 95% of JP Morgan's business line. And so that's what I mean when I say it's like this romanticized view of banking as we talk about this sort of thing and maybe not aligned with the actual risk factor of banks.
Yeah. Well, thank you for talking with me. I think that's a good place to end it.
Thank you very much.